In previous content, I've tried to focus solely on the deep and serious problems imposed on us by modern fiat monies and the various ways that Bitcoin directly addresses those problems. I've discussed some of the foundational technical elements of Bitcoin, as well as the properties that make it scarce, desirable, and fundamentally unlike any technology, monetary or otherwise, that has come before it. It's important that you understand what makes monetary systems fragile and repressive, and conversely, why Bitcoin is so resilient and enfranchising, and a bulk of my content will always be focused on that. However, I also understand that what attracts people to any given asset at first is the potential of that asset to grow their net worth. So today, I'll be focused less on evaluating Bitcoin as a technology, and more on evaluating it as an asset class. I'm Yevgeny Nurish, and this is Bitcoin as an investment. We all want to be wealthy. Most people don't start their Bitcoin journey because of their interest in sound, ethical, freedom-enabling money. They started because they want to get rich. This is, of course, perfectly reasonable and rational. In 2014, I didn't buy Bitcoin for the first time because I was worried about pernicious central banking practices, or because I thought it would be the future of finance, or because I was terribly concerned about my ability to move and transact unrestricted globally in any jurisdiction. I bought it because I was broke, and I was willing to take big risks on unproven things to multiply my wealth. Fast forward 8 years, and Bitcoin has matured far past the point of being unproven. While I consider Bitcoin much more than an investment these days, you don't get to the point of devoting 20 plus hours a week to making educational content about it overnight, and you most certainly don't start there. So today, I'm going to talk about Bitcoin as an investment, a means to the end of creating wealth, rather than an end in and of itself. While I do believe that once you truly understand the scope and power of Bitcoin, you become less concerned with evaluating it in terms of its price relationship to the US dollar, it takes time to get there, and it's important, at least in the near term, to understand the nature of that relationship. Price, of course, seems to be both the thing that most people care about and the easiest place to start. But rather than jumping directly into what economic factors impact Bitcoin's price in the short term, I'm going to address the archetypes of pre-Bitcoin individuals I encounter most frequently and their concerns and misunderstandings about Bitcoin as an investment. Keep in mind, this is not meant to shame anybody, and there's no shame whatsoever in falling into any of these categories or archetypes today. I make this content so that you don't stay that way. The first type of person we'll talk about is the too-later. This type of person asks questions like, isn't it too late to invest in Bitcoin? I feel like I missed the boat. This question indicates, more than anything, a misunderstanding about the fundamental value proposition of Bitcoin. Bitcoin is the only truly permanently scarce resource in the world, full stop. There are no other assets with a programmatically fixed supply. No matter how rare they are in a relative sense, miners can always extract more precious metals, governments can always print more money, and companies can always issue new shares of stock. You can't make more Bitcoin past the 21 millionth. Bitcoin will last forever, which means that as long as demand for Bitcoin grows, or even remains stable, the value of Bitcoin will increase, and its price will reflect that. This is among the most basic economic principles, supply and demand. This also means that there is no such thing as too late to Bitcoin. I purchased Bitcoin for the first time when it was about $300 per unit, and I've purchased Bitcoin at $67,000 per unit. I've purchased it at every price in between, and I will continue to purchase it until its dollar-denominated value is so high that it's no longer practical for me to allocate income towards it. Understand that the price of Bitcoin at any given time is a reflection of the level of collective understanding market participants have of Bitcoin as an asset class, rather than its fundamental value proposition, which never changes and only becomes clearer and more robust over time. If that's not entirely clear, here's an illustration of why it's never too late to acquire Bitcoin. Imagine for a moment that the internet were a company rather than a distributed ecosystem with no single owner. If you could go back in time and own any equity or any part at all of the thing we call the internet today in the year 1998, I think that everyone listening to this can agree that we would put every cent we had into that investment. Yet, At the end of 1998, the internet as a whole had just over 57 million global users. Less than 1% of the world's population, and about half of what Bitcoin has today. People thought the internet was just a passing fad, or it would have no lasting impact, and that its applications would be too limited to be a world-changing technology. Does that mean that the 7 billion people who didn't understand just how big of a deal the internet would become stupid? No. They just didn't have the vision or the imagination to see it, and they were behind the curve on adoption. This gave people who learned how to use the internet early, and especially businesses that built on top of it, an undeniable competitive advantage. Today, over 5 billion people use the internet nearly every single day, about 60% of the global population. You're able to listen to my words now because of the internet. In fact, as I mentioned in the orange pill, the internet is effectively a second world built on top of physical reality. And achieving any kind of financial success without understanding how to use it is increasingly nearing impossibility. Is it ever too late to learn to use something as important as the internet? The answer is, of course not. All that is required is a willingness to learn and understand. When you buy Bitcoin, what you're purchasing is a portion of a network as revolutionary as the internet. Except Bitcoin adoption is happening at nearly double the rate of internet adoption. We are still very, very early. Even if the rate of Bitcoin adoption were to be cut in half today, not an unreasonable assumption given current macroeconomic conditions, the network would still reach roughly 1 billion users before its 20th anniversary. The second archetype is the can't afforder. This type of person says things like, Bitcoin's really expensive. There's no way I can buy a whole Bitcoin today. There are a few fundamental misconceptions happening here. The first and most easily addressable is a psychological phenomenon called unit bias. Unit bias refers to the desire to own complete, round numbers of a given thing, and the resultant psychological satisfaction of doing so. It also refers to the tendency of humans to identify things as a single unit without accounting for the size or other critical characteristics of that unit. For instance, people see a 12-ounce can of soda and a 50-ounce Big Gulp and register both as one soda, even though the latter is nearly 5 times the size of a former. The reality is that you don't need to own whole units of Bitcoin or purchase Bitcoin in giant lump sums of single whole units because of a property called divisibility, meaning simply that it can be broken down into much smaller subunits. Bitcoin is not like a share of stock or a bond or a bar of gold or any other asset that you have to own either whole integer units of or none of. Bitcoins are divisible down to units of 1/100 millionths of a Bitcoin. These smallest divisible units are called Satoshis, or Sats for short, named after the creator of Bitcoin. You can acquire and hold any quantity of Bitcoin, all the way down to a single Satoshi, and Bitcoin functions precisely the same for every user of the network, regardless of how much they hold. Part of unit bias as it applies to investing is also that people assume an investment is not worth it unless they can own a lot of something, whether it's many shares of stock or a whole Bitcoin. This boils down to a simple misunderstanding of mathematics. Any investment worthwhile is worth that investment regardless of the quantity of capital you're able to commit. Whether you own one of something or 1 million of something, if making money is your primary concern, then all you should care about is the rate at which that thing accrues value, reflected as a percentage over a given period of time, typically annually. No matter how much Bitcoin, or for that matter any other asset you hold, the rate of price growth is the only factor that matters as far as the impact it has on your net worth. Whether you buy $10 worth of Bitcoin or $10,000 worth of Bitcoin, if your investment grows by 10% in a year, it's generated 10% annualized yield. If left to their own devices, the can't afforder will simply not invest in anything due to their fear of risk, and instead take their licks and watch their cash disintegrate over time due to inflation and taxation. This brings us to the third archetype, the crypto gambler. This group has a similar base concern to the can't afforders, but they come to a different conclusion. Rather than simply not investing and watching their cash rot away, or making stable, sound, conservative investments, the gambler wants to take outsized risks with extremely low probabilities of success, if they're even considering probability as a factor at all. It's easy to understand why this type of person is attracted to Bitcoin. It's become the highest return asset in all of financial history in a very short period of time, with early adopters making absurdly large investment multiples. However, the gambler fails to understand why Bitcoin specifically is valuable, and after coming to the false realization that they can't afford it or are too late to see the returns that the early adopters had, the gambler mistakenly associates the innovation of Bitcoin with cryptocurrency at large. Because they do not understand the fundamental value proposition and the difference between Bitcoin and other cryptocurrencies, they instead buy a large number of units of some meme token with no use case and no natural buyers in the hopes that they will quickly double or triple their investment. Then, inevitably, watch their investment go to zero when the liquidity rushes out of that token for one reason or another, usually because the token was a scam from the start. Bitcoin has held the same core functionality, use case, and principles from day one. And while in the early days it was a very risky investment because of uncertainty about its adoption, at this point it's very well established and is observably not subject to the same issues that cryptocurrencies with centralized issuers face. Projects like Ethereum or Binance Coin, which are securities, and stablecoins like Tether and USDC, which act more like currencies, are not fundamentally decentralized and have very different use cases and propositions than Bitcoin, which is a commodity, and should be evaluated differently. I'll talk in much greater detail about the crypto ecosystem, red flags, and scam/meme coins at large another time. But something everyone listening should be aware of is that anything in the world that offers a quick double up is gambling, not investing. Additionally, any investment opportunity, crypto or otherwise, that offers risk-free yield of any percentage or boasts a guaranteed return of any kind is a scam. Period. End of sentence. While Bitcoin has the highest price growth of any single asset of any kind ever, absolutely nobody in the world can or could at any point guarantee that, nor could they make promises or guarantees of its rate of return or make accurate price predictions. All such claims should be regarded with skepticism. As a general principle, you should factor in the risk of an investment going to zero in your overall assumptions about how that investment will perform. For example, let's say a man approaches you with an investment opportunity, a black box with a hole in it. He tells you that if you put money in the box, there's a 25% chance that it will double the money. In other words, generate a 100% rate of return, and a 75% chance that it will evaporate it. This means that while the advertised performance of the investment is a 100% rate of return, the risk of the investment reduces the expected value of that return to negative 25%. Meaning, on average, every time you use the box, you actually lose 25% of what you put in. In the crypto space, there are a lot of services offering between 5 and 10% annual yield for holding your Bitcoin right now. And the historical odds of those services going to zero and running off with your coins is close to 100%, which makes our little black box example seem like a great investment in comparison. Don't fall for these traps. If a service offers risk-free yield for deposits, guess what? The depositors are the yield. As a brief aside, and for a good point of reference, Warren Buffett, widely regarded as one of the best investors of all time, boasts a 9.4% compound annual return over the last 30 years. While Buffett is famously a conservative investor, the tortoise to the gambler's hare, he does a great job demonstrating that the goal of investment is long-term wealth generation and wealth preservation. Nothing worth doing is easy, and nothing of value is built overnight. The expectation of a quick double or triple up is misplaced in the world of investing. If that's what you're after, stay away from Bitcoin and go play slots in Vegas. The fourth and final archetype I'll talk about today is the market timer. This type of person says, I'm definitely going to buy Bitcoin, but I'll wait until the next price drop or bear market. That way I can buy even more, then sell when it's high, rinse and repeat. This is much easier said than done. If you're listening to this, there's a very good chance that you're not a trader, and that's perfectly fine. Trading is a full-time job, and the profession of trading requires tools, skills, and knowledge that take a great deal of time to understand, let alone master. While historically Bitcoin's price moves in cycles, nobody is able to determine in a given market cycle what the lowest or highest price of Bitcoin for that specific cycle will be. Just because trading platforms are accessible to everyone these days, it doesn't mean that everyone should trade. Even if you do aspire to be a trader, Bitcoin does not behave in the same way that other assets do, and markets are notoriously difficult to time. It is sporadically highly volatile, meaning that its price fluctuates wildly in very short periods of time and without much warning. Between 2010 and 2013, Bitcoin's price increased by 100 million%. And while that level of volatility is almost certain never to occur again, there have been several times in the last 2 years where the price has risen or fallen anywhere between 20 and 40% in a single day. When it comes to Bitcoin, you should take as conservative an approach as possible in the acquisition of that Bitcoin, rather than adopting risk by playing games with your time and money. The largest and most rapidly growing cohort of people who use Bitcoin as an investment or savings vehicle are called price-agnostic accumulators, meaning that they purchase Bitcoin regardless of the current price. These people do what is called dollar-cost averaging. Simply put, they convert a fixed number of dollars into Bitcoin at regular intervals. I'll be creating a video in the near future with some of the best services or methods of doing so soon. Separate from the risk you incur by trying to time markets, trading Bitcoin requires that you keep your money and your coins on exchanges to keep it accessible for trades. This means that you're sacrificing custody of your Bitcoin and entrusting it to an institution, which defeats the whole purpose of having trustless money. As we saw with the recent FTX implosion and other exchange implosions throughout the history of crypto markets, such as Mt. Gox, many of these custodians are unregulated, untrustworthy, and without proper governance or controls. And we run once more into the issue of trust that Bitcoin seeks to solve. I discuss in The Orange Pill the risk of using third-party custodians even for fiat money, and those risks apply doubly in these offshore unregulated exchange. If you don't control your keys and hold your Bitcoin in your wallet, they're not your coins. I'll take a deeper dive into the nature of and causes for Bitcoin price action and volatility in the next release. For now, keep the following in mind. Bitcoin is a tool for building generational wealth and promoting unrestricted, permissionless, frictionless trade. It is not a get-rich-quick scheme. Yes, Bitcoin is the best performing, highest appreciation asset that has ever existed. Yes, Bitcoin has many attributes that make it a very attractive investment, even if the current global financial status quo remains unchanged. No, that does not mean that the Bitcoin chart goes only up and to the right. There are mountainous peaks and deep trenches of volatility, and the people who reap the benefits of Bitcoin's appreciation are the people who hold on to the asset through these periods of extreme price volatility, while those with less conviction capitulate and give their Bitcoin to stronger hands. The word investment implies the allocation of capital over an extended period of time. As MicroStrategy CEO Michael Saylor says, if you wouldn't hold it for 10 years, you shouldn't hold it for 10 minutes. If anyone tries to tell you that Bitcoin is going to $1 million per unit by 2025, or you're going to buy your first Lambo with Bitcoin next year if you purchase Bitcoin today, that promise is not theirs to make, nor is it a good reason to enter the market. Bitcoin is the antithesis of the principles of materialism and consumerism that fiat money promotes. Because fiat currency degrades so quickly through inflation, it encourages you to spend it or reallocate it as quickly as possible. There's a reason the term, "this money is burning a hole in my pocket," exists. Instead, Bitcoin encourages its holders and users to increase their time horizon, the distance into the future that they look. Its greatest rewards are for those with the lowest time preference, that is, those who are most willing to exchange the fleeting short-term pleasure of impulsive consumption for the promise of a better tomorrow. Investing in Bitcoin is not something you should take lightly or do frivolously, especially if you're starting from the place of one of the 4 archetypes mentioned in this essay. Don't put yourself in a position where you are forced to sell your Bitcoin holdings to make payments or cover bills. Instead, purchase it conservatively and regularly, and increase the percentage of your allocation over time as you continue to expand on your understanding of Bitcoin and your confidence and conviction grow. I've said before that humans have the unique responsibility of existing in the present and determining what is yet to come in order to achieve true success. And the more of your net worth you allocate to Bitcoin, the more clearly you begin to see the future. Thank you for listening.